Hello everyone, and good morning or good afternoon, depending on what part of the world you're located. I would like to welcome you all to today's webinar on what effective climate-related financial disclosure looks like. Over the next hour, we'll discuss latest trends, in particular looking at EY's Climate Risk Disclosure Barometer, and we'll also clarify some common TCFD implementation challenges and offer examples of good practice. I'm thrilled to introduce you to our speakers today. Fiona Quinlan joined CDSB's technical team in 2019, having spent 6 years working in corporate sustainability reporting and strategy. During this time, she worked at Carbon Credentials as well as for the energy company Centrica. Youri is a senior manager in EY's Global Climate Change and Sustainability Services practice. He has particular experience in climate risk and ESG analysis with the oil and gas, banking and FMCG sectors, working on a wide range of international sustainability assignments throughout his career. So safe to say, I think we're in very capable hands today. And my name is Leslie McKenna. I'm the Communications Manager here at CDSB, and I'll be your moderator for today. We will also host a questions and answers session after the presentations, so we encourage you all to submit your questions using the Q&A function. You can activate this by clicking the 3-dot icon on the bottom of your screen, and this will open up the Q&A function on the right-hand side of your screen. Please do submit your questions throughout the presentation, and as I mentioned, we'll host the Q&A at the end of the presentations. So before we dive into the presentations, I would like to invite you all to participate in a quick poll. So the question we are asking you is, what is driving your interest in implementing the TCFD recommendations? And on the right-hand side of your screen, you should be able to see the poll. The answers are A, investor demand, B, changing regulation, C, part of your strategic planning and risk management processes, or D, desire to align with peers in your sector who are already disclosing. This is a multiple choice poll, so you can select more than one option. We've just had another few participants join, so I just want to repeat that we are currently running a poll. So please do participate in it. You can do so by selecting the option A, B, C, or D using the polling function on the right-hand side of the screen. Excellent. So I will leave that poll run for another 2 or 3 minutes in the background. So please do continue to input your answers, and then we'll discuss the results at the end. So with that, I would like you to pass you over to Youri, Senior Manager at EY.
Thanks, Leslie, and thank you for having me speak about a topic that we, as EY, get many questions about. Even though the recommendations were already published in 2017, we feel that really in the last year, we've reached a tipping point, and TCFD has become more of a mainstream term that many organizations are actually getting into a mature phase in. So what I'm going to do over the next 10 minutes or so is to provide you with a little bit of insight into the findings we have gained from a piece of annual analysis EY does over TCFD disclosures from companies around the world. So if you go to the next slide, Leslie. As many of you will know, EY is a large firm, and we have about 1,200 climate change specialists in many countries. So what we do, and what we've been doing over the past 2 years, is we've asked our colleagues to collectively review the climate change disclosures from the largest companies in their respective countries. To do this, we use a tool called the EY Climate Risk Barometer. This tool is able to analyze 2 aspects of TCFD disclosure. One is the coverage, so we look at how many of the recommendations are addressed, and 2 is the quality of disclosure. So of those recommendations that are addressed, how well have they been addressed? So our most recent analysis, which is over the 2018 and 2019 disclosures, looked at nearly 1,000 companies around the globe in all sectors of the TCFD. This analysis gives us really rich data, and we use this data to garner insights into the latest TCFD trends, but also compare countries and sectors with each other to understand what can be learned. So what are some of the insights we've gained? I'll present you with some of the quantitative findings first, and then I'll jump into some of the more practical considerations. So we go to the next slide. Yep. So what you see at the bottom is a comparison of scores across different companies. Yellow addresses the coverage, as I mentioned, so how many recommendations do companies address, and gray then indicates of these recommendations how's the quality of the disclosure. So there's a few things I want to highlight from our findings that we just saw purely looking at the numbers. The first thing is the differences across sectors, of course. Perhaps surprisingly, asset owners and asset managers, so the investors, are scoring the worst across all sector groups. This is maybe a bit surprising because TCFD is primarily designed to help investors. Investors have traditionally been very vocal about climate change, but they often lack quality disclosure themselves. So whilst asset owners continue to focus advocating for better climate-related disclosures from their investee companies, they didn't progress disclosures within their own sector themselves. Many asset owners and managers did consider climate change part of their broader ESG strategy or ESG framework, but they do not provide further discussion specific to the unique challenges of managing climate change risk. However, we do expect this to change quite rapidly this year, with a lot of regulatory reform on the horizon, especially in Europe and the United Kingdom, for regulated financial services firms. The second thing I wanted to highlight is the regional differences we saw. As I said, this is a global analysis that we've done, and so we were able to compare different countries with each other. A clear winner of our barometer was France. It's likely that regulation played a large role in the high quality disclosure of companies in France. For example, in 2015, the French energy transition law was enacted, which includes Article 173. This sets reporting obligations for a number of companies. Non-financial companies, for example, have to disclose information on Scope 3 emissions and their main source of emissions across the value chain. Financial institutions already have to report on the physical and transition risks to their activities and assets. While these laws have been in place for a while in France already, this has really given companies time to build capacity and their capabilities over the years. And so French companies have had a head start over others. I will get back to regulatory aspects in a minute as well. The last thing I wanted to highlight is that sectors affected by transition risk appear to be scoring the highest, and those affected by physical risk maybe a little bit less. So as you might know, arguably one of the most complicated asks of the TCFD is to test the resilience of a company under different climate change scenarios, and these are grouped into physical risk and transition risk. Many companies identify transition risk that either directly impact their sector or the supply chains they rely on. If a company had conducted scenario analysis, it has mostly been a transition risk that had been modeled, but not the physical risk. Likely one of the reasons for a more consistent consideration of transition risk is that the timescales over which companies and sectors are likely to feel the consequences are more immediate. Regulatory, policy, market, and technology risks, which are typical transition risks, are problems of today, whereas rising sea levels or changing temperatures are a problem of 100 years from now. This doesn't mean that companies have fully ignored physical risks. Transition risks are generally associated with mitigation action, which means actions that are taken to reduce the likelihood of physical consequences. So although in some sectors companies have considered the physical implications of climate change, they are yet to fully integrate these risks into their valuation models. So I want to move on to the next slide then. So there's a few other key takeaways that we saw from the qualitative analysis that we've done. So the first thing relates to the last point I just went into a little bit of detailed scenarios analysis talking about physical and transition risks and scenario modeling techniques. But I'd like to take a step back and show you what we are seeing in relation to the maturity of scenario analysis and the road that companies are going on when conducting scenario analysis. Because this year, we've really seen a step change in the publication of scenario analysis outcomes over previous years. When the TCFD recommendations came out in 2017, companies were really still wrapping their head around what scenario analysis is and how it should be conducted. So in 2018, many companies that we worked with went on an internal kind of learning journey. They explored different ways of how this can be feasibly conducted, gathering the troops internally, leveraging the expertise that already has. So over 2018 reporting, this led to a lot of kind of qualitative statements or commitments being made. That's last year, I mean. So we saw a lot of statements to the likes of, we will conduct scenario analysis in 2019. We also saw a little bit of qualitative scenario analysis. So by that, we saw disclosure of the types of risk that they might be exposed to. But what we didn't see last year, or at least very little, is actual quantitative analysis. This year, however, we've seen a number of companies making this change, and companies slowly starting publishing the results of their quantitative analysis. However, the way this is disclosed varies really, really widely. Some companies have decided to only do a small pilot of scenario analysis. So, for example, only looking at a few risks or looking at a limited scope of their operations. In terms of disclosures, most chose to only publish headline findings rather than actually publishing any numbers and stating that they have completed the quantitative analysis. So the second thing that we've tried to look at is looking at metrics and targets, and what is it? Many companies struggle to set meaningful targets and metrics, whilst environmental and commercial targets, such as reductions in carbon emissions and sale growth of green products, often exists. Considering the way in which these interact with each other is very difficult to do. For example, if a company has found from its scenario analysis it is most resilient under a 1.5 degree scenario, its emission targets were still in line with the 3.5 degree scenario. This begs for the question, why a company sets targets that can potentially be harmful to its own resilience. The third finding I wanted to highlight is that disclosure in financial filings is still limited. The TCFD recommendation asks for disclosures to be made in financial filings alongside other financial disclosures. However, this element of the recommendations is still to be widely implemented. Some companies did include their disclosures within the annual report as part of a discussion on the business strategy or as part of the director's report. However, the overwhelming majority reported either within their non-financial report, such as a sustainability report or a CDP report. Despite the TCFD recommendations, there are a number of reasons why most companies have not taken a step to include disclosures in their annual report. This might have to do with a relative immaturity of processes to capture and report on climate change risks, as well as the difficulty in setting timeframes and the potential implications of either transition or physical risk. So I'm going to move on to the next slide and talk a little bit about what we expect from this year's reporting season. Like I mentioned earlier, we've really seen an explosion of policy and regulatory announcements that will further drive the uptake of TCFD regulations, this TCFD disclosure. For example, in the UK, companies have been set the expectation to start reporting against TCFD by 2022, but we've also seen lots of related initiatives across Europe, Asia, South Africa, and America. In Europe, for example, the EU Sustainable Finance Action Plan also calls upon TCFD, and the EU Taxonomy's latest release also supports further disclosure. So as regulatory drive is maturing, companies should ensure that they keep overview of all different initiatives and understand how they link in with each other. Especially smaller organizations who are new to TCFD should look closely at how this evolves this year. The second thing that is related to this is the design of internal controls to support the quality of disclosures and the robustness of disclosures. One element of this is the ownership of TCFD disclosure. Who should be responsible for climate risk, or TCFD, has been a constant debate as it becomes increasingly embedded within the mandates of a wider range of executives. Traditionally, climate risk has been a responsibility of a chief sustainability officer or equivalent, but the financial nature of TCFD recommendations has meant that many are now debating whether responsibility should, or at least partially, be held by risk, strategy, finance, or another function. Accountability to different board committees is also changing, as reporting on climate committees such as climate to committees such as the Audit and the Risk Committee has increased last year. As interest in climate disclosure increases, companies are becoming more mindful of the need to design enhanced control environments surrounding TCFD disclosures. Finance and internal audit functions in particular are taking larger roles in organizations' response to climate change than in previous years, and we expect this to increase this year. So the third point is that there's greater investor sophistication of the use of TCFD information. Like I mentioned earlier, whilst investors have not been very good at disclosing TCFD against TCFD themselves, they have been working very hard on thinking about how they can use TCFD disclosure over the past 2 years. So investors have really been upping their game on the analysis of TCFD disclosures. So what we have seen last year and what we will see even more this year is the engagement with companies in their stewardship activity. But also, they increasingly leverage TCFD disclosures for their fundamental analysis. Companies disclosing against the TCFD recommendations should be prepared to face stronger investor scrutinies at their AGMs, but also in their day-to-day engagement with investors. So the last point I wanted to highlight is the drive towards net zero. There's an ever stronger push both from the public, but also from peers on the push to net zero. Over the past month, for example, we've seen major oil and gas companies announce their net zero targets. However, what's often lacking is a strong implementation plan to meet these targets. What levers are companies going to pull to make that net zero ambition happen? For example, what capital or operational expenditures are they going to make, and by when? And how does this affect their P&Ls? What are the intermediate milestones, and what is this all going to cost? If your company is looking to make a net zero statement, these are questions that should be considered and are very closely related to the TCFD disclosure itself. So what I want to close with is that TCFD disclosure is evolving really rapidly. We've seen a step change in the 2018 and 2019 disclosures over previous years, coming into a very mature phase where we can see real differences between companies. So I'm going to hand over back to Leslie.
Thank you very much, Youri. Really fascinating insights. And with that, I would like to pass over to Fiona Quinlan, who is the Technical Manager here at CDSB.
Great, thank you for that, Leslie. Just to check, can you hear me okay?
Yes, we can, loud and clear.
Perfect. Great, well, thank you, Leslie, and thank you, Youri, for that really insightful presentation. I think that actually provides excellent context for what I'm going to be covering next. So here at CDSB, we often get asked the question, how do I know when I've met the TCFD recommendations and what constitutes effective TCFD disclosure? So what I'm going to take you through now are some of the most common challenges and misconceptions that we're seeing and hearing in the market, which really echo, I think, some of the findings that Youri pulled out there. We'll then talk through kind of really how to tackle these challenges, which will lead us towards the TCFD to-do list, which we're hoping will ensure that you're producing effective and reliable climate-related financial disclosures. So just before we dive into that, I just wanted to provide a brief reminder for those who perhaps aren't familiar with CDSB of who we are and what we do. So we're a consortium of environmental and business NGOs. We were set up in 2007 at the World Economic Forum in Davos. Our secretariat is hosted by CDP on behalf of our board. And our mission is to provide decision-useful environmental information to markets via the mainstream corporate reports. And the way we do this is by offering a framework for reporting environmental and climate information in the mainstream reports. Next slide, please, Leslie. Great. So the CDSB framework provides a set of 7 principles and 12 requirements, which you see on the screen there. So the principles cover the how of what you can report, and then the 12 requirements themselves cover what information should be provided in your environmental disclosure. And our framework is fully aligned with the TCFD recommendations and its 7 underlying principles. It's also complementary to other reporting provisions such as CDP, GRI, SASB, and other regulations. So with the introductions out of the way, I'm now going to take you through our effective TCFD disclosure to-do list. So one of the most common misconceptions that we hear is that information can be disclosed in a separate TCFD or sustainability report. And as you saw from Youri's presentation, that is in fact where quite a lot of companies are choosing to put this information at the moment. However, as he mentioned, the TCFD recommendations themselves do say that the information should be provided in the mainstream report. When we say mainstream report, we're referring to the annual reporting package in which the company delivers its audited financial results. So this could also be referred to as the annual report and accounts, or perhaps the Form 10K in the US. So why should climate-related information be disclosed in mainstream reports? Well, the TCFD said that due to the non-diversifiable nature of climate risk, which affects nearly all industries, that investors want to see governance and risk management disclosures by all companies, so that these should therefore be provided in the mainstream report. It then said that where climate change is deemed material, information on strategy and metrics and targets should also be disclosed in the mainstream report. So why is mainstream disclosure important? Well, this is the report that companies use as their core communication to investors. So material climate information should be disclosed in the narrative and reflected in the numbers to support well-informed investor decision-making. If it's placed in other documents, it won't necessarily be as easy for investors to locate, and it won't be considered perhaps in the context of the company's wider strategy and performance. Now, what we would say is that additional disclosure could be provided in a supplementary report if perhaps it's providing further detail and supporting information. However, what's important is that the clear and material information is provided in a concise way in the mainstream report, and that any other disclosures are clearly linked out from this content. So one example of an organisation doing this quite effectively at the moment that we would point to is Shell. So they provide a concise summary of their climate-related financial disclosure in their annual report, and then they link out to their separate energy transition report for further detail on the scenario analysis work, but they're ensuring that the material content is in their mainstream report. Next slide, please. So the next challenge that we often hear is that investors aren't considering companies aren't considering climate change and reporting on it with the same quality as financial information, which limits its decision usefulness for investors. So another key point really, as has been mentioned before, is to ensure that the same rigor and management responsibility is applied to climate-related financial information. So while we wouldn't say that independent external assurance is necessarily a requirement, the information should be prepared as though it would be assured. So it should undergo the same or comparable internal controls and governance procedures as financial disclosures to ensure its reliability. And these applications of similar types of controls as financial information also help to address other challenging aspects of climate disclosure, such as the materiality of information, as this is itself a key aspect of financial disclosure too. So for further information on this area, a resource that we'd point to would be the guidance released last year by the World Business Council for Sustainable Development and the Danish auditor FSR, entitled Improving the Quality of ESG Information for Decision Making. So that guidance is a really helpful document which provides further detail on how you can get started in integrating this into your internal control processes. Next slide, please. So turning to our next challenge, another common criticism that we hear is that company disclosures on climate change can be of a boilerplate nature, so perhaps they're not sufficiently specific to the company or its particular circumstances, and maybe only address climate change in quite generic or high-level terms. However, clearly, in order for information to be useful for investors in line with the aims of the TCFD, it needs to be specific to the business. Generic and boilerplate disclosures aren't helpful to users of reporting. For example, if risks and opportunities from climate change are only reported at a societal level, but aren't perhaps linked back to the industry or business in question, not providing meaningful information. So in order to be specific to the reporting entity, disclosures need to be complete, but free from immaterial clutter and unnecessary or duplicative detail that obscures major trends and events that are specifically relevant to that organisation. So a good example of this would be EDF, who provide disclosure on the specific impacts of climate change for different parts of their business. So for example, operations, products and services, value chain, and their investments and acquisitions. So this helps to provide a contextualized view of how the EDF is integrating climate risk into these specific aspects of its business strategy. Next slide, please. So ensuring that climate change information is well linked to other aspects of business performance that are reported in the mainstream report is really key. So this can include strategic and financial disclosures, and this is something that is often cited as quite challenging in adopting the TCFD. So in order to be effective, this information must be connected across the mainstream report. So for example, if you're reporting on your business strategy, you should consider how climate-related risks and opportunities would impact that, and also put this into the different numbers that you'll be reporting in follow-up in your financial statements, where possible. So climate-related disclosure shouldn't be standalone and needs to be provided in the context of this wider information within the mainstream report. A simple means by which you might start to do this would be to provide page references between different areas of your annual report to link between the different sections. And then over time, you could move towards greater integration of both the narrative and quantitative aspects. A good example of practice that we point to here would be Schneider Electric. In their integrated report, they provide a clear table which summarizes the linkages and coherence across the different aspects of their climate disclosure. And then additionally, alongside reporting more traditional environmental metrics like carbon emissions, they also disclose indicators that clearly link to their wider business performance. So for example, they disclose the revenue that they're earning from energy and sustainability services. This then helps users to see more clearly the link between the climate-related information they're disclosing and their financial performance. Next slide, please. So as we've heard from Youri as well, another area of potential misconception that we encounter is that perhaps the sustainability or CSR department should be the department with responsibility for implementing TCFD. However, we'd see it as vital that buy-in is gained from across the business with leadership input and accountability from all relevant functions, which ensures an integrated disclosure. So a key way in which this can be demonstrated is through disclosures under the governance pillar of the recommendations, which are to illustrate which individuals and committees at board and management level have responsibilities relating to climate change information. So governance disclosures should be clear on the specific matters that are considered by board and management respectively, ideally outlining the relationships between the governance arrangements at these different levels and disclosing the specific actions that are being taken. So these should provide clarity on different business line or geographically specific arrangements if this is appropriate. So some good practice examples we'd bring to your attention here include the Italian utility Enel and the Royal Bank of Canada. So in Enel's reporting, they illustrate the responsibilities of each relevant committee. So they speak about the Control and Risk Committee and the Corporate Governance and Sustainability in its climate strategy. They then state specifically what each committee's role is, for example, examining climate-related targets or reviewing and approving non-financial reporting. And this also therefore provides clarity on arrangements within its other functions, regions and business lines. Then turning to the Royal Bank of Canada, they explain quite clearly the board and its committee's oversight of climate change. They then explain which other functions are involved in the various processes relating to climate issues and tie these responsibilities back to its management level performance goals. Next slide, please. So by qualified here, we mean that although organisations are now providing disclosure that addresses some of the TCFD recommendations, a common challenge we still see is the completeness of this disclosure, and again, to Youri's point, the quality of it. So here we see in the TCFD status report from last year that on average, companies were only making 3.6 of the 11 recommended disclosures under the TCFD. So we see it as really important that a clear statement is provided on conformance with the recommendations. This helps to provide transparency over which are the limitations of the current information. Alongside this, companies could state how they plan to address any existing disclosure gaps in future reporting. Ultimately, investors are quickly going to be able to determine what information is missing, so failing to acknowledge this in your disclosures doesn't necessarily do you any favours. And this would be in keeping with the 5-year implementation pathway, which was incorporated into the TCFD. which recognised that fully aligned disclosure was likely to be an iterative process over a number of disclosure cycles. So the key thing is to ensure that your disclosure demonstrates continued progress in improving transparency over time. So the good example to take a look at here would be the Australian insurer QBE. So within their TCFD disclosure, they actually provide a clear year-by-year roadmap on the actions that they're going to take over future reporting periods to enhance their TCFD disclosure, which is a really good level of transparency to provide if you're able to. Next slide, please. So a key aspect of the TCFD was the emphasis on providing forward-looking disclosures, particularly using scenario analysis. But as we've heard from Youri already, this is often an area that companies are struggling with and which is perhaps only starting to feed through in disclosures now. However, to provide effective climate-related financial disclosure, it's really key that information is forward-looking wherever possible. So a starting point to achieve this could be by complementing the historically focused climate information that you're already disclosing with some more narrative on its influence on future performance. So as well as looking at the past and present within your information, you should look to the future and try to communicate the trends and factors relating to climate change that are likely to affect your future position, performance and development. Ultimately, the users of the mainstream report want to understand if the business is going to be resilient to future climate-related risks and if you're positioned to take advantage of climate-related opportunities. So another key part of this would be providing clarity on the timeframes over which your risk management strategy is considering. So, for example, describing what you mean by short, medium, and long-term risk in this context. And that will really help to bring that future-looking perspective to your disclosure. Next slide, please. So again, as Youri said, whilst we've seen a growth in narrative TCFD disclosures, a key issue that we're still facing is that the quantitative information isn't following through, and ultimately tackling how to provide the disclosure on how climate strategy will be financed is a difficult area. So while companies in high impact sectors such as energy are generally starting to provide clearer disclosures on the integration of climate change into their business strategy, for example, where they're often perhaps still falling short is by linking this into their financial planning. So, for example, the disclosure on the strategic integration of low carbon opportunities into a business model isn't always followed through with clarity over the level of capital or R&D investment that's apportioned to these issues financially. So really trying to support your narrative reporting on climate-related matters by illustrating to your investors how you're executing this in your strategic and financial plans is a key aspect of effective disclosure. And really simply put, it's about ensuring that the company is putting its money where its mouth is in regards to its climate strategy. Next slide, please. So ultimately, I think all of these points now tie back to this ninth point that we've raised here, which is around the decisional usefulness of your information for your mainstream report users. So the key users of this information we would see as your investors, lenders, and insurance writers who increasingly need to integrate a company's specific understanding of these issues into their decision making. So useful things to keep in mind here will be thinking about who's reading your report and how they'll use it. So simple things that can help on this front to improve decision usefulness could be the formatting of your information, keeping it succinct and in a consistent and comparable structure over time. You can also consider the metrics that you're disclosing and whether these are consistent with those widely used for your sector. So, for example, are you using the same reporting boundaries and intensity metrics as other companies within your sector? So the Sustainability Accounting Standards Board standards could be a helpful reference point here. They've developed 77 industry-specific standards which set out financially material topics and their associated metrics for typical companies in an industry, which could be a really helpful starting point. So that concludes our TCFD to-do list. I hope that this provides you with some helpful suggestions as to how your organisation can overcome some of the key challenges and misconceptions regarding TCFD. So hopefully this will then enable you to provide more effective and decision-useful climate-related disclosure. So I'll now hand you back over to Leslie for the next part of our webinar. Thank you.
Thank you very much, Fiona, and again, some really fascinating insights. And I do just want to draw the audience's attention to some useful resources. Of course, the TCFD to-do list, which Fiona just talked us through, is available for download on the CDSB website. We also have the implementation guide, which outlined how to use the CDSB framework and SASB standards to implement the recommendations, along with the TCFD Good Practice Handbook, which is a really useful tool for you to see exactly how companies are disclosing, and it shows snippets of good practice and examples from annual reports. And then also do visit the TCFD Hub, the Knowledge Hub at tcfd.org, which is kind of the go-to database with lots of resources from different companies around the world. And then you can also access the climate disclosure online courses as well directly from the TCFD Hub. So we've had quite a few questions come in, which is great to see so much interaction from the audience, especially at this early hour, depending on where you're located. So I think what I'll do is I'm going to announce the poll results. So I'm just going to make these live now, and perhaps Fiona and Youri, you could give your kind of opinions or thoughts on what you thought from the results. So just as a reminder to attendees, the question that we asked was, what is driving your interest in implementing the TCFD recommendations? The options were A, investor demand. The percentage of people who voted for that was 26%. Changing regulation, 14% opted for that. C, desire to align with peers, 12%, and then 21% voted for part of strategic and risk management processes. So in fact, it was investor demand that kind of came out on top. Youri or Fiona, would you, either of you, like to comment on the findings, and if you're surprised or if that's what you expect to see?
Yeah, happy to just show my reflections. It's an interesting that it's a fairly even split across the four different answers that are possible. I think the D is really at the fundament of all other responses. Investor demand is probably increasing because they want to see how climate is integrated in strategic and risk planning. Changing regulations, again, are designed to integrate climate into strategic and risk planning, all of which leads to a more resilient company. So to me, all of these different answers are somewhat related to each other, which probably also explains why they have a fairly even split.
Yeah, no, I definitely agree with that. I think it's quite positive actually to see that a lot of organisations are seeing this as a key kind of strategic tool, not so much just that they're responding to investor demand, but they're thinking, you know, what's the opportunity for their business and responding to this. So I think that's a positive point. Yes, I guess it's obviously not too surprising as well that we see the regulatory driver as quite low because, you know, at the moment there aren't that many jurisdictions where this has been integrated in a regulatory sense, but perhaps that's something we may continue to see drive at the moment, drive forward in future as well.
Great, thank you. And then just briefly to let everyone know, we are hosting 2 webinars in May based on 2 publications that we're launching. So the first is the building blocks for successful TCFD disclosure with CDP. That webinar is taking place on the 13th of May, and registration is open for that. And CDSB are also launching a report on climate and environmental disclosure by major European countries, and that will take place on the launch will take place on the 19th of May. So again, registration is open for that. And that brings us then to the questions. So perhaps Youri, I will start with you, given that the first few questions that came in do relate to your presentation. And also for anyone who happened to join a little bit late, please do feel free to add your questions to the Q&A function, and we'll try and get through as many of them as we can in this time. If we don't manage to answer every question, we will follow up afterwards. So Youri, there was a question around the quality percentage in your presentation, and the question is, what does that quality reflect? Let me know if you want to go back to the slide or if you need a little bit more clarification on that.
No, yeah, that's fine. I understand what is being meant. So the quality aspect of disclosure looks at not only how many of the recommendations a company discloses, but how well it addresses a certain recommendation. So it looks at the level of transparency against the TCFD recommendations itself. So rather than just looking at have they given an answer, it also looks at how well do they disclose anything, and for this we use a standardized kind of methodology to assess the quality, which is available on our website.
Great, thank you. And also around the regions that you looked at, I know you mentioned France was kind of the standout region, but do you have any other reflections or comments on other regions, in particular kind of across Asia?
Yes, so Australia has been a very, very strong performer as well, and they have also traditionally been quite a strong performer more generally in climate-related disclosures. This is probably also has to do with the strong presence of the superannuation funds who have very strong viewpoints on climate, but also a strong reliance on heavy industry. And in particular, I mean, the mining sector over there is quite strong, which is for obvious reasons subject to strong climate regulation and impacts. In other areas of Asia, our latest analysis didn't show that they were quite as advanced as other markets, but we have seen a lot of activity kind of not yet coming to fruition in annual disclosures. So we have seen a lot of scenario analysis taking place, and a lot of organizations starting to think about how climate should be integrated into strategic planning and risk management frameworks, but this hasn't been disclosed yet. So we do expect that that other Asian regions countries will follow suit this year.
Brilliant. Thank you very much. Fiona, I'll give you a question that's specifically targeted to you based on your presentation, and it's around the point on the need to be specific. So the question is, if we try to be specific, we might have to describe our business model first. Is that recommended or needed?
Sure. Yeah, so I'd say definitely that's a really helpful disclosure to provide, and I agree that provides good context then for more specific disclosure afterwards. I guess what I'd say is that it's not necessarily the case that you need to provide a separate business model disclosure relating to climate change, but if within your mainstream report there's something on your business model that you're already disclosing, as most would, what's really helpful is if you can link through from that disclosure to your climate disclosure. So where it's meaningful to do so in your main business model, if you can think about the climate change risks and opportunities that impact your business model and start to articulate that, and then reference through from that disclosure to supplementary information on TCFD, I think indeed that provides useful context to your disclosure, as it kind of sits alongside, as you say, the specific information that you might provide on climate strategy. So hopefully that helps.
Great, thank you very much. We've also had a couple of questions come in around the guidance, Fiona, that you spoke about. So after the webinar, we will follow up with all attendees with a copy of the recording, and we'll also include links to the SASB standards and the guidance that you referenced, Fiona, throughout your presentation. A question to all panelists. So I think Fiona or Youri, whoever would like to take this one. Is the assignment of the CSO position recommended? So by that, I imagine they mean the Chief Sustainability Officer. And then if the CRO or the CFO covers this role, is it enough?
This is a very good question, and also a question that we see a lot of activities on that, as I mentioned in our in what I was talking about earlier. This is a constant topic of debate. Where should the ownership of climate risk sit? What is adequate is not something that I can answer, because this varies quite a lot from company to company, and also the specific mandate that the Chief Sustainability Officer has within your organization. What I do want to mention is that climate risk is becoming more and more strategic. So if a Chief Sustainability Officer has that mandate to influence business strategy and influence the risk management procedures, then the Chief Sustainability Officer is certainly the right person to assign this to. What we've often seen, however, is that that a Chief Risk Officer, if that exists, or a Chief Financial Officer, also takes ownership of TCFD disclosures, more from to give the ability to really integrate it into the core risk management process and key strategic processes that the organization already has. I've also seen models where there's a little bit of a combination of climate risk, where the disclosure, for example, is delegated to the CFO. The risk management aspect is delegated to the Chief Risk Officer, and the more the sustainability aspects and environmental aspects are delegated to the Chief Sustainability Officer. So that's another model that I've seen as well. I hope that helps.
Great, thanks, Youri. And I guess I fully agree with everything you said there. And I think the other thing that I'd add from a disclosure perspective is that I think, you know, as you said, multiple governance models will work depending on the organisation and what suits its specific circumstances. But I think from a disclosure point of view, being just really clear on what those roles are and specifically what their remits are is really important. So I think one thing we see sometimes in disclosures is that there's a simple statement that a given role has responsibility for climate change. But actually, if we dig beneath that a little bit more and think about, as you say, does that relate to signing off on disclosures, to setting strategy, etc., and thinking about the roles that those different positions play in the specific elements of governance is really helpful. So just providing that kind of clarity around those different roles and how they fit together.
Excellent, thank you. We've time for maybe one or two more questions, so I might just call both of them out at the same time, and perhaps Youri or Fiona, you can decide who's best to answer. I am conscious of the time, so I don't want to hold up our attendees and of course our panelists for too much longer. So actually, Youri, this one is directly for you. So you mentioned companies setting targets that are potentially harmful to their resilience. Could you elaborate or give any examples on this? And then the other question is around scenario analysis to both Youri and Fiona. It's about whether a 2 degrees and a 4 degrees scenario is okay, if that's enough.
Yep, that's a good question, and it's the first one on the targets that are harmful to the resilience of a company. So one of the things that we've been doing is looking at the outcomes of scenario analysis, and this is now, as I mentioned earlier, there's a lot more data this year than there was last year. A number of companies have come out of this scenario analysis showing that the 1.5 degree scenarios is the most favorable, for example, for a company, right? So they have a 1.5 scenario, and they look at the 1.5, they look at the 2 degree scenario and the 3.5 degree scenario. I'm just giving an example, right? And this particular company I'm thinking of came out most positive in a 1.5 degree scenario. However, they have set a greenhouse gas emission reduction target that is more in line with a 3.5 degree scenario. So why would they set themselves a target if the business is most resilient on a 1.5 degree scenario? I hope that makes sense. So it would make more sense if a company set a target that is in line with the scenario under which they are most resilient. That's the first question. The second question, remind me what it was?
It was about the scenario. So if a 2 degree scenario and a 4 degree scenario is enough.
It could be. Again, the different scenarios that different companies use different scenarios. A 2 degree scenario and a 4 degree scenario could be one of those that you apply. The TCFD recommends different scenarios than those, but it's up to the organization to choose which scenarios they find most likely themselves, and they want to model against. Often referenced scenarios are those set out by the IEA, however, which are the is a 2-degree scenario, a beyond 2-degree scenario, and often also companies choose to model themselves against a 1.5-degree scenario. But it's up to a disclosing organization to choose the scenarios themselves.
Thanks very much, Youri. Really insightful. Fiona, do you have anything to add on that before we sign off?
Yeah, no, I think I'd agree with what Youri said there. I think I'd point to our TCFD hub, which I think the link will be in the slides when we share them, which is a helpful resource. So you can see there some case studies of companies that have done scenario analysis and various pieces of guidance around this, which might help to think through what are the most appropriate scenarios to choose for your organizations. I think some organizations as a starting point did find, I think it's Unilever, did broadly speaking a 2-degree and a 4-degree scenario and used that to characterize a 2-degree scenario as one which was broadly transition risk focused, and then a 4-degree scenario as one that was broadly physical risk focused. So they found that, I guess, a helpful starting point, perhaps a little bit more simplistic in terms of the characteristics of the scenarios in some organizations, but a good way to characterize, I guess, those 2 different risk areas. So yeah, certainly it could be a good way to go to start with.
Excellent. Thank you very much, Fiona. That unfortunately does bring us to the end of today's webinar. Thank you so much to everyone who joined us, who participated in the polling, who also submitted their questions. Unfortunately, we haven't been able to get through them all, but please do reach out to us directly on info@cdsb.net, and we can address your questions or your answers, and I can also forward those on to Youri or Fiona. So thank you once again to our fantastic panelists, such great insights and fantastic way, I think, to start the day. So thank you to everyone, and I hope to see you all on future webinars, and have a lovely day. Bye-bye.